You might have noticed some ETFs will fall behind the S&P 500 one year and then outperform it the next depending on market conditions. Well, today we're going to look at an ETF that tracks very closely the S&P 500, really closely in fact, regardless of market conditions. More importantly, the S&P 500 yields about 1.5% and this fund yields almost 7%. Have you ever noticed the catchy ticker symbol names popping up lately like JEPI and SPYI? Well, this isn't one of them. QDPL sounds like a programming language that would land you a job at Facebook. The Pacer Metaurus US Large Cap Dividend Multiplier 400 ETF doesn't exactly roll off the tongue either. So to keep things simple, I'm going to make up a name just for this video. And I'm going to call it Pacer 400. Now it sounds like a NASCAR race, and NASCAR knows how to keep things simple. So let's see how much money this Pacer 400 ETF can make for us and how risky it is or isn't. The first distribution back in 2021 wasn't a full 3-month quarter, so we can ignore that. Since then, though, each quarter the fund spits out a payment of just over 50 cents. On today's price of $30.42, the current yield is 6.85%. This channel is focused on high yield, and 6.85% is, well, a little bit light. So if you're thinking it must do more than just pay the 6.85%, you're right. The reason this fund is worth looking at today is it appreciates more than the competing high-income ETFs. This chart is price only, no dividends. It shows how the Pacer 400 compensates for its lower yield with more price appreciation than the competitors. If we include dividends, the gaps do narrow, but Pacer 400 is still doing well over the past year. The distributions from covered core funds like JEPI and XYLD look like Swiss Alps because their option strategies are driven by market volatility, so they're always going up and down. The Pacer 400 distribution, not volatile. This is the first clue that it's built differently from other high-yield index funds. A consistent dividend sounds good if you're retired, but it would be nice if it went up instead of looking so flat. The good news is that this fund is constructed to mirror the growth of the S&P 500 dividends, so let's take a quick peek at those. The S&P 500 yields less than 2%, and over the short term, it doesn't really seem to be going up. But if we zoom out, sure enough, S&P 500 dividends grow consistently over the long term. A quick disclaimer, I'm not a financial advisor. Since retiring in 2017, I began researching my investments in far greater depth because, well, now they pay for everything. When I find something interesting, I make a video. Let's start with how the Pacer 400 pays 4 times the S&P 500 dividends. Roughly 12% of the fund is sitting in cash and treasuries. That's used as collateral to enter futures contracts called S&P 500 Annual Dividend Index Futures. Those futures contracts deliver the value of the S&P 500 dividends, but not the S&P 500 price movement. The futures contracts are equally divided into 3 time periods: current year, next year, and the year after. Each December, they're rolled. That means the current year expires, next year becomes the current year, and so on. The reason they buy contracts up to 3 years out and roll them is that the returns for contracts in that range of duration provide attractive returns, meaning they're pretty cheap to buy. I'll show you what I mean about getting a good price. This chart shows the difference between the implied price of the futures contracts and what the actual dividends are likely to be. The gap between the two is the source of the income provided by these dividend futures contracts. If you'd like to know more about why dividend futures are priced so attractively, Professor Van Binsbergen from the Wharton School has been studying this subject for a decade.
Over this collective time period that you see here, essentially these dividend futures contracts have all outperformed their respective indices themselves, meaning that investing your money in these short-term dividends gave you a higher return than compared to having invested in the underlying index such as the S&P 500.
The rest of the Pacer 400 holdings are simply the stocks from the S&P 500. They buy the actual stocks in the same proportions as the index. Those stocks represent approximately 88% of the fund, and they're free to rise or fall, just like the S&P 500. They also pay the regular S&P 500 dividend of just over 1.5%, which contributes, well, a little bit, to the fund's distribution. After reading the website, the fact sheet, the prospectus, What else? Pace's 10-page explanation of dividend futures and watching the professor's hour-long lecture. I feel like I understand about 90% of the fund's mechanics. I still have a few unanswered questions, so if there's a lot of interest in this video, I'll reach out to the fund manager and see if he wants to do an interview. I think he could potentially provide a better verbal explanation than what's currently available in all those written materials. Last thing I'll mention about the structure of the fund is the fee at 0.79%. It is a bit high for a passive fund. You're not really paying for a manager to trade around market conditions, so my assumption is you're paying for the formula. The sub-advisor to the fund, Metaurus, created the index that the fund is based on. They also execute on the strategy, which isn't really that complicated. It's just a matter of mirroring the S&P 500 holdings, and that's easy, and rolling the annual futures contracts every December. But maybe if the fund manager comes on, he could explain there's more that they do in exchange for the fee. Apart from the yield, here's what I like about the Pacer 400 ETF. The obvious benefit of this fund over covered call funds is that for the 88% that's invested in S&P 500 stocks, the upside isn't capped. So when the S&P 500 goes on a run, it will capture 88% of the upside. We can see that here when comparing price action to the S&P 500 and its competitors over the past year. Looking at price and ignoring dividends, Pacer 400 or QDPL is behind the S&P 500, but it's ahead of the competition. The less obvious benefit is the dividend is derived from the actual S&P 500 dividend, not from selling options. The funds that sell options like JEPI and XYLD will generate more income when volatility is high and less when it's low, like right now. By contrast, the Pacer 400 yield has nothing to do with volatility whatsoever. More importantly, as I mentioned earlier, the S&P 500 dividends grow over the long term, so I expect the Pacer 400 distributions will grow at a similar rate. The tax story for the Pacer 400 fund is similar to my experience with SPYI. My research dug up a significant amount of return of capital, which led me to ask questions like, is the return of capital destructive or simply a tax treatment? I searched the Pacer website, the prospectus, and every other document I could find, and no explanation. That is, until I found this 2021 interview with Sean O'Hara from Pacer.
So you'll have a tax treatment on your normal dividend as qualified dividend for part of it. You'll have a tax treatment on that piece of it that's 60% long-term, 40% short-term. And part of it actually will be return of capital from a tax perspective. So about 65% of the 5.3% on the quadruple dividend product is not going to be currently taxable income.
So he clearly explains that it's a tax treatment, and that's good. That's an excellent feature of the fund that their marketing materials don't address. I'll link the full interview in the description. It's not that long. If you're wondering where I find these clips and other research, it's mostly the articles from Seeking Alpha. They go into much more detail than I can in a 10-minute video, and I never buy a stock or a fund without first researching it on Seeking Alpha. Link in the description for a free trial and any promotions that they're currently offering. They change all the time. Here are the risks and concerns I have about the Pacer 400 fund. S&P 500 dividends generally increase over time, but if they take a hit, like they did during the 2008 global financial crisis, it would have an outsized impact on this fund. For example, if the S&P 500 dividend yield fell from 1.5% to 1%, 0.5% drop, that would cause the Pacer 400 dividend to fall from 6% down to 4%, 2% drop, because the dividends are magnified by a factor of 4. Now, that's not a huge risk because historically large drops in S&P 500 dividends are rare, and even though it affects Pacer 400 more than the index, it still doesn't move the needle that much, and it's likely to recover anyway. The other risk is the reliance on the futures market to deliver the expected income. You're not getting the actual dividends from the S&P 500 companies, you're getting a payment created by a financial instrument. The correlation between the futures market and the stock market should remain constant, but it's just not guaranteed. To put it more simply, anytime you add a derivative, it's just one more thing that can go wrong, even though the risk of that is pretty small. What I like about the Pacer 400 is that it offers enough appreciation and income growth that I would be comfortable spending, well, all the income. In other words, I think the income will outpace inflation. I also like the consistency of the income, and that after a bullish year and a bearish year, it's managed to keep up with the S&P 500 for total return, and that's not easy to do through those cycles. The only reason I haven't purchased this fund is that I'm currently seeking just a little bit more yield than 6.85%. However, in the future, I will shift my focus to income growth for new entrants to my portfolio, and this fund will be on my shortlist. For a lot of people, 6.85% yield is pretty healthy, and the blend of income and appreciation I think would make sense. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, I made a playlist to save you time. That wraps it up for the Pacer 400, aka QDPL. More armchair income coming soon.